In some cases, you can't really avoid it anyway because, you might be making 500-600K.
Coming back to negative gearing, it's obviously you're making a loss on the property.
Yeah.
So it puts undue financial pressure on the family just so you get a tax refund.
Depreciation isn't just for new properties though, is it?
No. It's better for new properties.
So the investment strategy, lower your taxable income. I've always said to people, if you want to lower your taxable income, get a shittier job. Stop earning too much, Stop earning 200K. Welcome back to Talk Property to Me. My name is Brad East.
I'm Aaron Downey.
And I'm Joel Griffiths. Thank you for having me.
No worries, mate. So what we're going to be talking about today is some typical tax benefits for property investors. We're also going to be looking at some of the pros and cons of purchasing through corporate entities versus in your personal names. And we're also going to talk about how some property investors are using corporate entities to buy multiple properties and some of the benefits and downsides to doing that as well.
Yeah.
So we'll get straight into it. Joel, can you run us through some of the typical tax benefits for property investors, including negative gearing, capital gains, depreciation, interest expenses, all those sort of things that we would generally see?
Yeah, so in respect to obviously holding property as an individual, the negative gearing piece, where basically your rental expenses in respect to a property exceed the rental income, and that loss can be offset against any other income that you generate. Most of the time it should pay a pay-as-you-go job.
Yep.
And returning a bit of a tax refund when you lodge your return.
Mm-hmm.
Now, obviously that's just on a tax point of view that we're talking there. Sticking with negative gearing is, I've said it before, you want to make sure that you're getting that capital growth in respect to the property to offset the negative gearing. Otherwise, you're kind of going backwards.
Yep.
So that's sort of the thing about negative gearing. Capital gains, if you are holding that property as an investment property and you do hold that property for greater than 12 months, you're entitled to a 50% discount on the profit.
So how is capital gains calculated and added? Is it just added to your taxable income?
Correct.
Yep.
Correct. So, for example, you buy a property for $100,000, you sell it in 2 years for $200,000, that's a $100,000 gain. You get to apply the 50% discount to that gain.
50.
And then if that's held in your own name, 100%, then that goes against your taxable income for that particular year when you actually have the sale.
So that could push your tax bracket up quite substantially.
Yeah, exactly. So
are you able to push that out over multiple years, or do you have to do it in that taxable year?
That taxable year.
Yeah. So selling down properties, leading into retirement can be quite expensive.
Yeah, so there are things that you possibly would want to do when you do sell these properties, if there are unrealised gains there, is to actually sell them when you know that your income or your taxable income is going to be a lot less.
Yeah.
So when you do retire, that could be an opportunity to actually start offloading some properties if you wanted to.
So you'd want to have near no income in that year.
Correct. Or no taxable income. So if you're
income,
retired, generally most of the income that you're getting from a pension or your super or things like that are tax-free.
Yeah.
Generally.
Yeah, and it's probably a good strategy. I know for a lot of people who I deal with, they're acquiring property to potentially change careers as well and use that money to fund, their lifestyle change or whatever it is. So it's probably a good thing for them to do it after they finish up with their role and sell off their properties and take that money and do whatever they want to do in the future.
That's right. And we've got examples where the wife goes on maternity leave and she's got property in her own name. They see that as an opportunity to then sort of liquidate some of the properties that they've got in her name.
Yeah.
Because she's on maternity leave, her ability to earn income is a lot less. Her taxable income is going to be a lot less. So it is tax efficient to sell those properties in those particular years where she's having children.
In some cases, you can't really avoid it anyway because, you might be making 500-600K off a property. Then half of that, 250 adding on, doesn't really matter what your personal income is.
You just want to make sure that you are absorbing those lower marginal tax rates if you have the opportunity.
Yeah.
But then if you are selling for large profit, then you're going to be in top rate territory anyway.
Yeah.
So depreciation deductions, you want to explain what a depreciation deduction is? Yeah,
so with depreciation, any of the plant and equipment that is purchased in respect to the property can be written off over time, generally useful life. The ATO have a lot of information out there in respect to what they deem as acceptable in respect to the write-off periods. So, for example, you might put a new air conditioner or something into an investment property, you just go into the ATO website. There are some documents and things in there which say, okay, you get to write that off over 10 years or 15 years or whatever. So depending on that, and then also the nature of the spend. So if there's something there that's actually more of a fixture to the building, so if you go and put a roof on, that's more of a capital asset. So that's written off under a different type of legislation. That's Division 43. So that's written off at 2.5% over the life of the asset. So a lot of people get quantity surveyors reports as well when they buy new property. So the quantity surveyor goes in and actually carves out all of the plant and equipment that was purchased with the investment property, so that then you have a schedule of things that you can claim when you do your tax return.
Yeah, depreciation isn't just for new properties though, is it?
No. It's better for new properties because you can get that QS report and you do get a lot more value out of that. If you buy an older property, obviously a lot of the assets there have been written off over time anyway, and there's no intrinsic value there. So generally,
unless you're doing a small renovation or something like
that's
that.
exactly right.
Yep.
Over what time frame would you say it's probably not worth getting one?
Oh, it's hard to say, but I would, anything over 5 years, you probably would be. It's probably not worth it.
Yeah.
And that's using diminishing value, is it?
Yeah.
Yeah.
So you've got interest expenses as well. So I'll explain that one. When you're paying off a home loan, you've got two options. You've got principal and interest, and you've got interest only. In regards to claiming those repayments, it's only the interest portion of the repayment you're able to claim. Hence why a lot of investors go interest only.
Yeah, a lot of people go interest only on investment properties too, because that frees up that principal amount that you're paying off the deductible debt to go and reduce non-deductible debt. So
correct.
In other words, if you've got your home, which obviously is non-deductible debt, and you've got an investment property, we generally encourage people to put the investment property on interest only and sort of quarantine that debt base so your deductions are higher. Mm-hmm. And then any of that cash flow that's sort of saved in respect to going IO instead of to P&I, you then whack that off your own home loan.
Yeah, I 100% agree with that. Your priority should be paying off your non-tax deductible owner-occupied debt.
Correct.
You know, there's plenty of people out there. Yes, principal and interest repayments is sometimes better for serviceability because the way that lenders work out your borrowing capacity with interest only is they subtract the interest only period from that term. So let's say you've got a 30-year term and you want 5 years interest only, they calculate your repayments off 25 years.
Yeah.
So it does reduce your borrowing capacity a little bit for some people, but overall, I think you're better off purchasing for a little bit less on interest only.
Yep. Agreed.
So
well, I think before we move on to the corporate entities, it's probably good to provide an example of negative gearing, the pros and cons of it, and why you potentially wouldn't do it as well, because we didn't touch too much on the negative gearing piece.
Okay, so coming back to negative gearing, it's obviously you're making a loss on the property. So the actual rental income coming in is less than the amount of expenses in respect to the property. So coming back to your comments there, I would actually say that negative gearing has a benefit, especially for people in high income earners, and they're generally the people that are investing. So, for example, if you had a $10,000 loss on a property, and that would include all the depreciation and everything like that. So that's actually not just the cash loss; it's actually the depreciation coming on top.
Yeah.
If you're in the top marginal rate territory, you're kind of getting a tax deduction of $10,000 off your other income, and based on the marginal rates at the moment, 47% off that as a tax deduction is pretty good going. So it's $4,700.
Yeah.
So you're sort of getting that as a saving at tax time. But you need to, as I said before, we need to be very mindful in respect to negative gearing. You want to make sure that investment is actually sort of negative gearing is being offset by capital growth. Otherwise, your net wealth position is actually going backwards.
Yeah.
And I think people need to acknowledge too that the negative gearing is only lowering your tax you're still paying for the other portion of it.
Yeah, that's right. And
Yeah,
you still got to.
You know, if your tax bracket's 37% or whatever it is, you're still paying the other part.
Yeah.
You know.
And that's why I asked the question, because a lot of people just want to buy property for negative gearing, but sometimes it just doesn't make sense, because if you are reducing your taxable income by $10,000 and you've only got a marginal tax rate of 32 cents to the dollar.
It might not be
It's-
worth it.
The other 60-odd%
And
you're paying for.
Yeah.
And
it's
if-
out of your pocket
Exactly.
each week.
That's right. And if you're on that marginal rate, you might only be a middle income earner, and sort of having to fund $10,000 a year is a big hole in the family
is.
budget.
Yeah.
So it puts undue financial pressure on the family just so you get a tax refund.
Yeah.
Doesn't
Yeah.
make sense.
Yeah.
There is people out there that really sprue that as part of the investment strategy. Lower your taxable income. You know, I've always said to people, if you want to lower your taxable income, get a shittier job. Stop earning too much. You know, stop earning 200K. Go work at Macca's. That'll lower it heaps.
Yeah, you might not have the lifestyle that you enjoyed, but yeah.
If you want to lower your taxable income, there's better ways to do it.
Yeah.
There
And you
really
don't
is.
have to work as hard.
Exactly. You know,
Yeah.
so that's something that people need to acknowledge, that if you're buying property for negative gearing purposes, that it is going to cost you money.
Exactly.
You know,
Yeah.
it's not a freebie tax deduction. It's
And
because
that's-
it's costing you money.
And that's the big stigma when, people get together at the pub and start talking about things like this. It's
Yeah.
like, oh, yeah, I got a refund of X. Well, mate, it's cost you $10,000 in after-tax money during the year.
Yeah.
In these cases, do you recommend people is it a tax variation?
You can
Do you
do
recommend
those.
that? So that's basically where you
depends.
you estimate what your loss is going to be for the year, and that lowers your tax bracket throughout the year.
Yeah,
So
then your employer takes less tax out.
Correct,
So,
or do you
we
prefer
don't
just
do
wait
it
till
very
the end?
often. If you've got a large loss, I would possibly do it, because then you don't have to wait.
Frees your cash flow up a little bit.
Exactly. So your employer would not be withholding as much tax out, because they get a pay-as-you-go with withholding variation notification from the ATO. You basically fill in a form and say, this is what I estimate everything to be for this year. And then the ATO will send your employer a notification saying, well, this is what you need to withhold on this basis. So you might...
And then you manually update that in your...
Yeah, so you might... So then
payroll
when
system.
when you lodge your tax return, you're not getting the refund, because you kind of got the saving along the year.
Yeah.
And there's margin for error there, isn't there?
Absolutely.
A lot of the time.
Yes.
So any other tax benefits for property investors that I haven't listed on here? You're the tax expert.
That's pretty much covered it.
Tax-free equity release.
Yep. So we'll move on now to corporate entities versus personal names. I am seeing this, I think we're all seeing this, grow in popularity, is purchasing via corporate entities. So instead of going out and buying it in Mr. and Mrs. Jones, they're going and buying it into Mr. and Mrs. Jones Proprietary Limited, or corporate trustee for a trust, whatever it is. Do you get all of these benefits that we've just talked about? Do you get that if you purchase under a corporate entity?
No, you don't. So with a corporate entity, the CGT discount that we spoke about before is carved out, so you don't get access to that.
So all of a sudden your 500K profit, instead of claiming 250 off straight away.
That's right. So if depending on what the company does, generally it would be a 30% tax at the company level if you're just doing sort of passive property investment.
Yep.
And then so your profit would be taxed at 30%.
So you're going to lose 30% of your growth, essentially.
Yeah. So 30% would then so if you're sort of comparing what the scenario would be under the discount method as an individual, their tax is going to be 23.5%, which is half of the top marginal tax rate.
Yep.
So you kind of, with a corporate, the tax is definitely higher at the time. But the thing with a corporate is there is a thing called imputation and franking credits, which we can probably talk about a little bit later, where when you do pay the profits out to the shareholders from that particular corporate entity, the franking credits or the tax that's been paid on those profits will flow out to the shareholders or the mum and dad.
And you can space that over a few years.
You can
can't
be strategic with the way you do pay those profits out.
Except for a trust. I think a trust has to be distributed same year.
Correct.
Doesn't it? Yep.
Correct. unless, well, if you don't distribute the profits of the trustee's taxed at 47%. So it's
Or you can move it from a trust to another company. Though,
you can,
can't you?
depending on the
company.
deed. Yes,
Yeah.
and that is a strategy that a lot of people use.
Yeah. So they'll set up a separate entity again where all the profit goes into.
Yeah.
So you do lose a lot of those. So I'll run through some of the things. Obviously, personal name, it is very straightforward. You know, it's in your names, minimal administrative requirements. You're eligible for those capital gains discounts. The problem is some people, they see that it's a personal risk because it's in your name, so legal risks. And sometimes it's a higher marginal tax rate, depending. The pros of a corporate entity sometimes is asset protection. It is completely separate, fixed tax rate, but obviously you get the opposite of that. One thing that I wanted to point out as well is just like I own and run 2 businesses, and I don't know how much of a pain in the arse that is with tax returns and all the stuff that you have to do on a monthly basis.
Yeah.
This isn't a set and forget
No.
process. If you're buying properties under a corporate entity each time, you might have 10 entities. Can you imagine the administration costs for that as well?
Yeah. The compliance costs would be high.
Yeah.
The other thing as well is if there is negative gearing present in the early days of these properties, the losses need to be funded from somewhere.
Yep.
And they're quarantined at the company level. So you can't generate a loss or negative gearing at the company and then transfer that to mum and dad. It's stuck. So
and then you as your PAYG and your company is running at a loss because that's what it's going to do for.
yeah,
We'll talk about that in a minute. Usually about 6-7 years before it's cash flow positive. You're then tipping taxed income into that company.
correct. After tax money.
after tax money.
So it's tax inefficient, really,
Yeah.
in doing that. So unless you've got other things going on in that corporate where those losses or the negative gearing can offset possibly other investments or possibly a business or things like that, which I wouldn't do anyway because of an asset protection issue, the negative gearing piece doesn't really work.
No. Yeah, so mate, it's a lot for people to sort of consider. Any advice for, do you say it's a blanket yes or a blanket no for buying in corporates or?
It depends on the level of gearing. So as you're coming back to sort of whether or not you've actually got profit or you've got negative gearing in these particular entities. I've got a few clients where definitely we do have property in companies, and the reason for that is that the gearing level on those particular properties are very low. So there is basically profit there that is actually taxed at 30% and they're earning good money outside of this particular structure, so they're not taxed at 47%. Right. And they're building wealth inside this particular entity outside of their super. So it's kind of, they're building a bit of a portfolio outside of their superannuation because you're limited with how much you can get into super and things like that. So that when they do retire, there's going to be no debt in this company. There's going to be a lot of property in there. There's going to be rent coming in, which will create profit. It will be taxed at 30%. These guys will be retired based on current law. Their taxable incomes, again, when they've met the retirement age and condition of release, their taxable income is going to be zero. So when we actually make all this money at the corporate level, we can pay dividends to them and get back the tax that's been paid at the corporate level because the franking credits at 30%. They've got a fair bit of marginal tax rates to absorb before they're actually going to be paying gap tax on that money.
Yeah. So it's recommended if the property is heavily cash flow positive.
Pretty much, yes.
Yeah.
Someone with a substantial cash contribution to...
Yeah, so when I win the $100 million lottery,
yes.
I'll buy all my properties in corporate structures.
Yes.
Yeah. Until then,
and the other thing about a corporate is that you do actually get the land tax threshold in a company. So when you get over the 1.075 million unimproved capital value, I think that's the number at the moment, then you'll start paying land tax. Whereas if you have a trust, for example, you pay land tax from $1.
Yep. So what I'm going to quickly talk about now is, so there's a lot of talk at the moment about how buying in these corporate entities can actually increase your borrowing capacity. So I'm just going to quickly explain that to the listeners on how that actually works. So it doesn't technically increase your borrowing capacity. Let's be clear with that. So what it relies on is actually getting a letter from your accountant saying that that corporate entity is trading profitably and that there's no, cash flow required from the person on a personal level, that then is then excluded from serviceability altogether. So you don't put the debt in, you don't put the income in. It's like it never exists. Sorry. So for that to be correct, it's relying on a few things. Obviously, the property needs to be cash flow positive. So I worked out on a $850,000 property with stamp duty in New South Wales, 10% deposit, loan amount based out on that. LMI added to that, 6% interest only rate with a 5% rental yield, so quite generous, and capital growth at 7%, and estimated annual expenses of around 1% of the property value. I'm not sure how accurate that is. That's what AI gave me.
No, it is just
pretty standard, 1%.
Depending on the property and
So based on that, and let's bear in mind that 5% rental yield is quite generous.
Yeah, and that's the thing. When you're getting up around 5% yields, you're compensating on your growth a lot of the time as
Correct.
Exactly, yeah.
So for that scenario, it would actually take 6 years for the property to become profitable.
Yeah.
Now, so I played around with those numbers as well. And when you calculate, so when you look at Merewether as an example, which is a high growth area, low yield area, the actual rental yield is on average is 2.99.
Yeah.
It actually blows that cash flow positive number out to 16 years. So
That's a long time to find that extra money to
it's
cover.
a long time to wait for a letter.
Yeah.
You know what I mean?
Yeah.
And then we're sort of then getting into to the grey area where accountants are putting stuff on letters they shouldn't, and I'm not saying that that's a thing, but possibly is.
Yeah.
But these things come back to bite you. If you're trying to avoid serviceability, there's probably a reason why lenders do serviceability calculations. It's so that you don't go broke.
Yeah, so the loan gets repaid.
So the loan gets repaid. If you're trying to avoid that by setting up all these complex structures and doing all this shit, you're putting yourself at risk, in my opinion, of literally not being able to afford the repayments, everything getting taken off you, all for what? So that you can have 2 extra properties and tell everyone you've got.
And that's the thing. It's potentially not even 2, because if in your personal name you're capped at, say, funding 3 investments that are negatively geared, with this structure you might still only be able to pay for 4.
Exactly.
So just for one more property to set up all of these different entities, and like you said, auditing the compliance risks, and
then you're missing out on that 50% capital gains deduction, discount.
So just on sort of that, the premium scenario with using these corporates is where you might have another business somewhere that's quite successful, and that business the shares in that business are held in a trust. Profits from that business are then paid into that particular trust, and then the trust makes a declaration at year end, basically saying that I'm going to appoint the profit to this particular holding company or the bucket company. Now that is a tax efficient way of getting money into this particular bucket company. The cash flow that's realised in the bucket company can then go and buy these properties, and there's no debt. So that's where you would use, and the cost of actually getting the money from the corporate through the trust to another corporate, worst case scenario is 5% tax.
Yeah.
Because you might have a company over here that's paying tax at 25% because it's a trading company and it's a base rate entity and its turnover's under a certain cap, and then it funnels this profit from a trust into another bucket. The bucket will pay tax at 30% on that distribution.
Yeah.
But it's already getting a franking credit of 25%. So it's costing you 5% to get the money in.
And then you use that cash.
Use that cash to go and buy the property.
Yeah.
That's where I see a good structure to actually do that sort of corporate strategy in respect to building portfolios. If you've got to go the whole thing about just sort of being a mum and dad with no sort of other thing going on over here, and then trying to drip feed money into these things for serviceability over time, it's so inefficient way of doing it.
And that's the thing. It's more so the mums and dads that are trying to set up these structures just to increase their serviceability to get another property.
And when you set up a new corporate entity to then purchase these properties through, they're considered a non-trading entity, so we don't need financials, we don't need any of that sort of stuff. But then you need a serviceability guarantor, which is the mum and dad. So they're going to see your pay slips, they're going to do a servicing calculation based on that purchase anyway.
Yeah.
So it's for that individual purchase, it's not going to increase your borrowing capacity at all.
Because there's got to be a guarantee somewhere.
Correct. The
banks aren't that silly.
there are some situations where, depending on the property purchase, so let's say you're buying a boarding house, you're not able to do that under your personal name with a lot of lenders, for one, because they won't accept that as a residential security, and then they won't accept all of the rental income. That's when you can buy it through a company and they'll accept 100% of the rent.
Yep.
There are situations like that where it can be better for borrowing capacity to do it through the company, but in most cases, it doesn't increase your borrowing capacity by purchasing it under a corporate entity. It's just that people think they've found a loophole where they can get that letter, and then that letter is then used to exclude that company from your next purchase. So,
And it's a lot of people stick with residential and do this structure to try and get a bigger portfolio. It's probably best to reach your serviceability cap or just before it, and then go into commercial to increase your yields.
Yep.
Yeah.
Yeah. So that's pretty much it for today. What we are going to talk about on another episode is how to increase that, I guess, overall yield via granny flats and some other different things. But that's a completely different episode where we're going to discuss the rental income increase, which is great, but we're also going to discuss how much that property could be worth when you want to sell it.
Yeah.
Because not everyone wants to buy a property with a granny flat.
Yeah.
So we'll talk about that on the next episode. But until then, thanks for listening.
Thanks
for
guys.
joining.
Cheers.
Thank you.